Today, we're going to tackle a question that could seriously change the way you build your portfolio. And that question is, are you making a common and pretty costly mistake by investing way too close to home?
Wow. This quote from Vanguard's Bilal Hassanji, it just gets right to the point, doesn't it? And look, he's talking about Canadian investors here, but this is a huge issue for people all over the world. It's this hidden risk that so many of us are taking, and we don't even know it. And to put a number on it, get this. Vanguard found that Canadian investors put a whopping 55.6% of their stock portfolios into their own domestic companies. Now, that might sound patriotic, but when you realize Canada makes up only about 3% of the entire global stock market, you can see how lopsided that is. That's what we call home bias. Okay, so let's dive into this idea, the home bias trap. We're going to break down what this problem is because it affects so many of us without us even realizing it. You know, it's just human nature, right? We like to stick with what we know. We feel comfortable with the companies we see every single day. But here's the catch. In the world of investing, that preference for the familiar means you might be putting all your eggs in one country's basket, and you could be missing out on a whole world of opportunities. So, if staying home is the problem, what's the solution? You guessed it, going global. Let's really get into how international diversification can build a stronger, much more resilient portfolio for you. I love this analogy. It just makes so much sense. Investing only at home, that's like going to the store with a tiny little basket. You can only grab a few things from the local aisle. But global diversification, that's like having a giant shopping cart, and you can roll through the entire superstore, grabbing the best stuff the whole world has to offer. You're not just tied to one local economy. You're taking part in the success of the entire global marketplace. So, what's the big deal about going global? Well, it's not just about, adding more stocks for the sake of it. It's about fundamentally improving how your investments are built. You get access to way more companies, you tap into economies that are growing at totally different speeds, and this is the big one, you can actually lower your overall risk because not all markets move up and down at the same time. And this chart right here really shows you why that matters. I mean, look, the US market is an absolute giant, no question, but it's still just one piece of the puzzle. If your entire portfolio is just in one country, no matter how big it is, you're basically fishing in a small pond when there's this massive global ocean of opportunity right there for the taking. Okay, so that's the theory, and it sounds good, but how does this actually play out in the real world, with all its economic ups and downs? Let's look at the evidence. All right, so during those times when the US economy is expanding and doing well, you can see that, lots of global markets do well too. It's that classic a rising tide lifts all boats scenario. This is what we all hope for, but it's really only half the story. But this is where diversification really shows what it's made of. When the US hits a recession and its market is struggling, look what happens. Some international markets can actually hold their ground. You can see here, a market like Japan was able to post positive returns. That is diversification at work. When one major economy is down, others can help cushion the blow. Okay, but let's be real. It's not a perfect magic shield. To really get this, we have to talk about a really important complication in how global markets behave, especially when things get tough. Now, here's a key concept. The term is asymmetric correlation. Sounds a bit technical, I know, but the idea behind it is actually pretty simple. Correlation just means how closely two things move together. Asymmetric correlation just means that relationship changes, and the benefits of diversification can actually shrink right at the moment you need them the most. Let me break that down. So here's the bottom line. When things are going well, when markets are climbing, countries all over the world kind of dance to their own beat. But when things get scary, and a major market like the US starts to fall, everything tends to fall together. It's like they all start holding hands on the way down. So diversification definitely helps smooth out the ride, but it won't always save you from a sharp global downturn. And you can see that asymmetry in action right here in this chart. See the bar on the left? That shows a lower connection or correlation when the US market is doing well. But now look at the bar on the right. It's much higher. That shows the correlation spikes when the US market is down. It means other global markets are much more likely to get pulled down right along with it during a downturn. So, given this complication, this idea that markets can all fall together, we have to ask the big question, is global diversification still worth it?
Let's weigh the final evidence and see if we can reach a verdict. Right, it's a common concern and it's a totally fair one. People think, okay, if I invest in Japan, am I going to get wiped out if the value of the yen suddenly changes? And while currency risk is definitely a real thing, the research shows it's not the deal breaker many people think it is. Why? Well, in a really well-diversified global portfolio, you're exposed to a whole bunch of different currencies, which actually helps cancel out the really big swings. Plus, over the long term, its impact tends to fade into the background.
So let's tie all this together. What's the big takeaway here? It's this. Despite the imperfections, overcoming that home bias is one of the most fundamental steps you can take. A really good rule of thumb is to try and have your home country's allocation be much, much closer to its actual slice of the global economic pie. For most of us, that means building a much stronger, more resilient portfolio by looking beyond our own borders. And that's the question I want to leave you with. Is your portfolio truly built for your future? By being built for the whole world? Or is it maybe a little too concentrated in just one small corner of it? Thanks for joining this explainer.